Now, I think the kicker is going to be this, is that I don't think we're going back to that 2% or under that the Fed really wants us to get to for years. And I think that's going to be a big issue down the line, as they're not going to be able to stimulate if we go into a recession. So if you think about it, every recession we've had for the last 20 years, basically, the Fed has stimulated in some way, whether it's printing of money or dropping interest rates or buying bonds to have on their balance sheet. They've been doing massive stimulus. That was all with 2% or less inflation. The fact is, we're at a point where unless they get that below 2%, they can't print money again to save us from the next recession. And that's the boogeyman to me. That's the real scary thing. If this economy goes into recession, how do we get out without the Fed's help?
Hello and welcome to Wealthy Value. In today's video, Chief Market Strategist at InTheMoneyStocks.com, Gareth Soloway, warns about the upcoming Bitcoin crash that can wipe out 80 to 85% of Bitcoin's price. Gareth also speaks about his market outlook for September 2022, Fed's next policy after rate hikes and inflation, and what to expect in the next CPI report. Make sure to stick around till the end of this video, where Gareth Soloway reveals his thoughts about the Ethereum merge and its impact on Bitcoin and other cryptocurrencies. If you liked the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
With the volatility in the stock market, there's been some great plays. You know, the markets had gotten crushed from June through July into early August. Then we saw the stock market stage a massive rally up, then a big fall just in the last couple of weeks before this latest bounce. So I would say in stocks, it's been tremendously good in terms of swing trading and day trading and kind of positioning yourself. And then I also think, you know, gold is starting to look very interesting down here. It's looking like it's trying to hold support. And I think the biggest thing out there that investors should be paying attention to is the dollar and then the 10-year yield. And those both have been on a tear lately, although it does look like the dollar may have topped. So short term, we probably have a near-term top in the dollar. It doesn't necessarily mean we can't go higher in a few months, but there were some key things that actually happened here. And I'm going to bring up and I'm going to show this chart for you guys. Let me just bring up my charts here and I'll show you guys what we have going on. But if we look at the US dollar, the USD JPY, which is the dollar yen, I want to show you this. So this is a line that I was following recently, and you saw the yen was just getting crushed against the dollar more and more. But look at the trend line that we just hit a couple days ago, and that to me was a signal that the dollar may start to weaken. And sure enough, we've started to see that. We should see a continued pullback on the dollar yen all the way back to at least 139. So there should be some more downside. That does imply that the dollar, the DXY, should also stay weaker in the near term. But that was a big one for me. Like so much of this market has been driven by the strength in the dollar. And what I mean by that is, as the dollar was going higher, stocks and risk assets were getting crushed. We even saw gold getting crushed, right? So the fact that the dollar near term has topped, it should give the stock market, crypto, a little bit of a reprieve to maybe have a small bounce higher. Yeah, so Bitcoin's been dancing right around that 20,000 level. And the reason why I was harping on 20,000 is because that happened to be the high from the last bull cycle. So in 2017, we saw this unbelievable percentage move to 20,000, and then the bear market started. Finally, we got into the next bull market. And then basically when price came down there, you would expect it to have some bounce and some sideways chop. And that's exactly what we've seen here. It doesn't change my view that Bitcoin is not at a bottom yet. Bitcoin in its normal bear market cycles goes down about 80 to 85%. I think it's only down about 70%. And this is the first bear cycle the Federal Reserve has not been printing money during it, right? So in every past bear market cycle, the Fed's been printing money with QE and QE1, QE2, and all those. And this is this first cycle it isn't printing money. And that makes me wonder if at least we go down 80 to 85%, which gives me that 12 to 13,000 target, or could we actually go even a little bit lower? So I think that we're still going to see another leg down, minimum 12 to 13,000, and then I'll have to reevaluate if it's going to go lower after that. Yeah, so I think that is a very important aspect about reducing energy, because I know that a lot of fund managers and investment portfolio managers, one of the things that they're always pressured on is being very environmentally conscious, right? So that's going to alleviate that issue. And then also the merge is going to change the way the mining is done, which almost creates it as a deflationary asset, almost like kind of a Bitcoin. So I actually think longer term, this is really bullish for Ethereum. And I do think that it makes it much more attractive to investors overall, not just for the utility purposes, but also for the savings and kind of a different way to invest versus holding US dollars and other currencies, fiat currencies. So I think that's very good. I think the biggest thing next week with the merge is it has to go smoothly, right? So, and this is big for the entire crypto market. Everyone's looking to that. They need to nail it to give the confidence to the crypto markets. If they do, I think you could get a little short-term upside, kind of the relief of, okay, it happened, it went smoothly. It doesn't change the fact that I think eventually Bitcoin's going to 12, 13,000, but in the near term, it should be a positive. So, I mean, I think at this point, the rally we had from even 2009 when the Fed began printing money was so vertical that it pulled forward a lot of the upside in the market, very much like you saw happen in China about 10, 12 years ago, Brazil 10, 12 years ago. And what's interesting about those markets is they've been chopping sideways for 10 years, actually more than 10 years. And so it's very similar. Like you look at, in fact, let me show this chart. I want to show you this because it's super powerful to kind of envision here. So if we go to the monthly chart on the S&P, this was the 90 run, the pullback, the 2000 up to 2007, the pullback. And then this is where the Fed started printing money. And look at that. That is not a natural market move. Now, what's interesting here is if we go to something like the EWZ, which is the Brazil ETF, look at this move on the Brazil ETF. And then again, go back to, put that trend line in, let me erase that. And then go back to the SPX again and look at that same move. It's almost identical, right? The vertical nature. And if you look at the EWZ, which is the Brazil market, the ETF for the Brazil, what did it do after that? It topped out after this ridiculous run, big correction, upside, downside, upside, and basically it's been chopping sideways now since the high in 2008. And so you're now talking 14 years that the Brazil market has not outperformed. And if you look at the Hang Seng market, it's very similar, right? Let me bring up that correct chart here. Bear with me, Hang Seng, there we go. So again, if we look at that chart, you had this monster run from 2003 to 2007, and then look at the chart, how again, it's basically trading currently at levels that it was trading back in 2006. And so you're talking about 14, 16 years of sideways action in the Hang Seng China stock market without a real breakout to the upside. So I look at this move and all I see is the S&P over the last, 11 years, right? Since 2000, since 2009. So back last 12 years, 13 years. So that's my concern, is that we're now entering this phase of the cycle. And again, markets work on cycles, folks. You have to understand that. And so I am concerned we're going to see this, then we're going to see a lot of this for like 10 years before we finally break out. Now, having said that, the question is, well, where do you invest? Well, the two charts I just showed you, to me, you don't want to obviously overinvest, but if I had to choose right now, US market be long or China slash Brazil and some of those countries, the South American countries, I would absolutely be going towards those for the next bull move. Yeah, so I found that so fascinating, right? And so let's rewind even more to Jackson Hole. So Jackson Hole, he came out extremely hawkish, like the most hawkish I think we'd ever heard him speak. And the markets freaked out, and we saw a big sell-off that day, and really the following 1 week period was a massive sell-off in the stock market. But if you look at the underlying factors, the market, the bond market, which is actually the smarter of markets, it's the market that has more money, it has more big money. So people think about it as being the smarter of the markets when you compare the stock market to the bond market. The bond market did not believe him, right? So let me bring up this chart, and I think this is such a cool chart to show. So we're going to look at the 10-year yield chart. So the 10-year yield, which is interest rates. And if you look at, this is the daily chart, and over here, this was in June. So in June, the 10-year yield was at 3.5%. When the comments for Jackson Hole came out, we were at 3.1, and we've only gone back to 3.3, even with the most hawkish comments the Fed has ever put out on hiking rates and being just hard against inflation. And what that tells me is that they believed that rates were going to go higher back here than over here. And so basically the bond market is calling the bluff from Jerome Powell and saying, you know what, we think you're talking a tough game, but we think that when the economy starts to weaken, you're going to back off really quickly, and we're not going to see rates as high as what the stock market is thinking in this situation. And I think you could almost confirm that with the DXY, right? So yesterday, or in the last couple of days, we had those comments from Jerome Powell again. He reiterated his hawkishness. And what happens to the dollar? Instead of rallying higher, it actually fell. And so again, now the currency markets are starting to doubt Jerome Powell. So I'm in the camp that I think it all depends on the CPI data next week, whether it's 50 or 75. But I do think if the inflation comes down decently, we might only see 50 basis points in the September meeting.
So, what are your thoughts on Gareth's prediction about upcoming Bitcoin crash? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.